Good morning, everyone. We'd like to welcome everyone here today to the Office of Municipal Securities 2023 Disclosure Conference. My name is Adam Allegramento, and I'm a special counsel in the Office of Municipal Securities. On behalf of the office, we want to thank everyone in the audience here today, and we're very excited to have a robust discussion on disclosure in the municipal securities market. Before I begin the day, we did want to give the disclaimer that all SEC speaking today are speaking in their official capacity and that they do not necessarily reflect the views of the Commission, any individual commissioner, or other SEC staff. A quick overview of the day. We're very excited that the conference will open with remarks from Chair Gary Gensler, and after his opening remarks, we'll move to panel one, hosted by Deputy Director Adam Wendell, to talk about voluntary disclosure in the municipal securities market. After a brief break, we'll have panel two, hosted by Mary Simpkins, Senior Special Counsel in our office, to discuss the Financial Data Transparency Act. After lunch, we'll reconvene to hear comments from Commissioner Jaime Lizarraga before moving into our third panel on broad risks. After another short break, we're lucky to hear from Commissioner Hester Peirce before moving into our final panel of the day, hosted by Director Dave Sanchez on current disclosure topics. Dave, afterward, will give concluding remarks. I would like to begin the conference by saying how lucky we are to have Chair Gary Gensler here today to give opening remarks. Chair Gensler has been chair of the Commission since 2021, and please, with me, thank Gary Gensler for being here. Thank you. Thank you very much.
Thank you, Adam, for those brief remarks, and thank you all for being here. It's great to be back in the auditorium, by the way, and to be able to do this in a hybrid fashion. And I know some of you are online, and we're fortunate to have, 70 or so of you here in person. I'm going to say it a little differently than Adam. I'd like to start to say that these are my own thoughts as chair of the SEC. So I am speaking for one commissioner, Adam, but not on behalf of my fellow commissioners or the staff. Look, later this month, geez, I've got my twin brother echoing back here, but on the 27th of this month, we'll mark the 90th anniversary of the Securities Act of 1933. That was the first of the federal securities laws. And when crafting the federal securities laws, Congress, Roosevelt, they understood something. They understood the importance of the bond markets. Now, the focus, of course, was the '29 stock market crash and so forth. But among the many terms that they included in that very first definition of security were bond, note, debenture. With the focus of protecting investors in the bond markets, they actually came back, and Congress later passed the Trust Indenture Act in 1939. It's not something that many of you in the municipal markets work on, but it sort of highlights the importance of the bond market in those early days. Now, one might say that the Trust Indenture Act is kind of like the Rodney Dangerfield of the securities law. Important, but discussed not that often. Yeah, some of you are too young to remember Rodney Dangerfield. Initially, the municipal securities markets, of course, were exempt from many of the federal securities laws except with respect to anti-fraud protections. And that was true of the U.S. Treasury market as well. But things changed. Fast forward about 4 decades, it's in the 1970s, New York City nearly went bankrupt. Congress came together in 1975, acted establishing a regulatory scheme for intermediaries in the municipal securities markets, requiring broker-dealers in these markets to register, and creating the Municipal Securities Rulemaking Board. Interestingly, it took yet another decade, 1986, for the Government Securities Act and to bring treasuries more into our remit, shared, of course, with the U.S. Department of Treasury and the like. And here we had a little bit of a sharing with the Municipal Securities Rulemaking Board. Based on these authorities, by 1989, the Commission adopted, and you all know then more recently in 2018, amended rules around disclosure, 15C212. And the rule basically ensures that those that are acting as underwriters of municipal securities confirm that the issuers agree to make continuous disclosures to investors, and that the disclosures are available in a manner designated by the SEC. If I could just mention, back to the 30s, the basic bargain was investors get to decide what risks they take. We're a merit-neutral agency, but there is full, fair, and truthful disclosure. And that's why Roosevelt actually called the 33 Act the Truth in Securities Act. It's not exactly the same in municipals. There's a lot of reasons for that. But by 1989, based on the authorities, underwriters of municipal securities had to confirm these various disclosures. Further, under the rules, brokers must confirm that issuers agree to make disclosures with respect to official statements, annual financial information, and you all know this wonderful list, the 16 relevant material events. These important disclosure rules both help protect investors and facilitate capital formation by municipal issuers. We also, at the agency, have a role as a cop on the beat in the vast $100 trillion capital market, but we also do in the municipal space as well. And we recently charged 4 underwriters for disclosure-related violations while offering municipal bonds. Given that markets, technology, and business models continue to evolve, it's helpful to hear from you all at this conference today, both in person and in hybrid, about ways to enhance disclosure in this part of our markets. I look forward to hearing from the panel talking and thinking about voluntary disclosures. Such disclosures can help build greater trust in our marketplace. That can benefit investors as well as lower cost of capital for the issuers. I'm also pleased that you'll be taking up this opportunity to discuss this new bill that passed Congress, Financial Data Transparency Act. Overseen by the SEC, the Municipal Securities Rulemaking Board maintains an important data repository for municipal markets. Again, you're probably even more familiar with it than I am. I think, though, that this repository, it could benefit issuers, investors, and the markets alike if we consider ways to enhance the efficient submission and processing of data in these markets. Further, it helps to ensure that the public has ready access to that data. Before I close, I just want to sort of say just how important this $4 trillion marketplace is. It provides fundamentally access to the markets for local governments to provide basic services for their communities. Whether it's building roads, schools, parks, bridges, hospitals, keeping the public safe, keeping the public educated, all of that they do and more is facilitated by these important municipal markets. Now, we at the SEC, we oversee the public markets for about 7,000 public companies, you all know there's about 50,000 municipal issuers. So it's quite a difference. But even more so and more strikingly, while you see those ratios, there's nearly outstanding 1 million municipal securities. 1 million. More than 30 times the number of outstanding corporate bonds. So a lot of work, smaller issuers, less liquidity, of course. So we at the SEC, we benefit from your participation today, your continued engagement with our Office of Municipal Securities, and what you're discussing today about voluntary disclosures and the new act that just passed last year. I thank you. I thank those of you that came in person. I thank those of you that are listening in online. Who do I hand it back to? Adam. Thank you.
OMS would like to, again, thank you, Chair Gensler, for kicking off our conference. Before I turn it over to our first panel, moderated by Deputy Director Adam Wendell, 2 points of housekeeping quickly. After the panel, we will have a short break, but I want to remind everyone to please come back by 11:15. And second, we would like to have question and answers after each panel. So if you're attending in person, please assemble at the microphone when it's time. And alternatively, if you're attending via teleconference, feel free to send any questions you have to municonference2023@sec.gov, and we look forward to answering those questions if we have time. Without further ado, Adam.
Thank you, Adam, and good morning, everyone. As I was reading through my introductions of past panels I've moderated, I noticed that I always use a strange sports analogy in my introduction. So this time, I had to come up with another one. Let's say that Chair Gensler was our leadoff man, and now our panel is coming in as the number 2 hitter, which means we have to both drive the chair home and also set the table for the remaining panels. I hope we can have a wide-ranging discussion of how voluntary disclosure can be valuable to issuers of municipal securities and other market participants, what factors currently drive or impede an issuer's decision to make voluntary disclosure, including what, when, and where to disclose, and how to expand the voluntary disclosure universe. Before we jump into our discussion, let me briefly introduce our panelists. Ahmed Abunama is the Chief Financial Officer and Director of the Department of Finance for the City of Cleveland, Ohio. Prior to joining the city, Ahmed spent over 6 years here at the SEC, where he served in a variety of leadership roles, including as Director of the Office of Credit Ratings and as Deputy Director of the Office of Municipal Securities. Prior to joining the SEC, Ahmed worked as a public finance attorney at Squire Patton Boggs. Camille Evans is the co-founder and managing partner of Virtus LLP. In addition, she serves on the board of directors of the National Association of Securities Professionals and is a fellow of the American College of Bond Counsel. Drew Kinsinger is counsel in the Washington, D.C. office of Hunton Andrews Kurth and focuses his practice on municipal securities matters. He is a former president of the National Association of Bond Lawyers. Ann Ross has several decades of experience in the corporate world as a buy and sell side analyst and as a high-yield investment banker. She established her own consulting firm in 2014, advising hedge funds, asset managers, financial guarantors, and financial technology firms, providing municipal credit analysis, modeling credit metrics, and identification of distressed credits held in portfolio. She is a past chair of the National Federation of Municipal Analysts and serves as its current co-chair of the Industry Practices Committee, member of its DEI committee. She also spent 20 years on the advisory council to GASB. So those are our panelists. And we'll get right started with the first question that is always on everyone's mind when we talk about voluntary disclosure, which is, what is the value of voluntary disclosure? You often hear people say that nothing issuers or obligors disclose impacts pricing and it only subjects them to liability. So why do it? Ahmed, we'll start with you as a producer of such disclosures. You're good.
I'm good? Okay, great. Good morning, everyone. It's great to be back in the SEC's headquarters and speaking again at this conference. I'll also note that if you see things flying through the air, it's probably because Emily and Ben are throwing them at me as an issuer. So, voluntary disclosure is a really expansive topic. The Office of Municipal Securities has addressed it in a variety of formats through some staff guidance over the years. And, my general view as an issuer now, which is a bit different than it was before I joined the city, is that, we produce a lot of information every month, every week. There are reports we have to produce for city council. So in our codified ordinances, the finance department has to produce a monthly financial report for city council, which provides a really interesting and helpful snapshot of our current financial condition with respect to our expenditures, our revenues, actuals to budget, et cetera. But even outside of the financial space, we do produce a lot of information, whether it be press releases or other presentations that are given to city council. And I certainly do review those with an eye toward what kind of information we're putting out into the market. So, some folks maybe in our press office or in the mayor's office might want to embellish certain facts or information. And I've made sure that in the workflow of that information being made public, that someone in the finance department lays eyes on those documents to make sure that we're not embellishing information that could, in someone's eyes, be significant. The one thing that hasn't changed about my views on voluntary disclosure is that it's very important and it's useful for the market. I think, information is kind of a public utility in our space, in the securities markets more broadly. It is what allows the various actors in the market to trust each other. And so it's really important for me in my role to get as much good information out there as we possibly can, so that at a minimum, holding pricing aside, we are viewed as a good citizen in the market and that we have good hygiene with respect to disclosing information, whether it's good or bad.
Great, thank you. Anne, as a consumer of such disclosures, would you like to weigh in on the value?
Yes, thank you. I would argue that there is tremendous value in providing voluntary disclosures, and we see that as equivalency to interim disclosures. It has value, most particularly in between bond issuance. Obviously, if you're a frequent bond issuer, that's going to be current market. That's always available to the investor to make a credit decision and to assess risk. The voluntary disclosures, certainly we saw had value during the pandemic, but it's also good interim disclosure between the filings of the issuer's information to EMMA, which at best might be posted 6 months after the close of the fiscal year end. Many disclose within 9 months, some even 360 days. So this is stale information. It's getting information that tells you where you've been. You're looking in the rearview mirror, but the investment community would like to know where you're headed. Now, we can sort that out by seeing interim disclosures, which we understand does exist. We are not asking any issuer to reinvent the wheel or engage in special project reporting, but rather to disclose some of this interim data that they do present to other entities, whether it's state legislators, city councils, even the federal government. The value is particularly helpful in the secondary market, where you don't have updated information and you need to make an investment decision, a risk assessment, and then to understand if the price of the offering of the bonds is compensating you for that risk. Also, it does help to bridge the gap, as I said, between the CDA filings, their legacy filings, and quite frankly, unless the bonds have been taken out of their first optional call at 10 years, which is a lengthy period of time, many of these bonds remain outstanding 15, 25 years later. And as we all know, the world has changed. There might be a different information set that is now necessary to have at hand. And the legacy CDAs do not address such information. And certainly, largely, they do not address interim filings, except, of course, those who, for instance, file budget to actual comparisons. But that's really been the extent of it. So we see this as a great tool, an efficient tool to get information out into the market that is as near real time as it could possibly be. It helps inform an investor's decision, and it also broadens the base of the potential buyers when they see a robust set of disclosures that are filed frequently and certainly on time. Because obviously the late filings are quite significant. So we see it as an effective way to get your information out. Ahmed had said that it's about trust, and it is. This is a trust relationship between the investor and the issuer. And the better your information is, the more current it is, all inures to the benefit of the issuer.
Great, thank you. Camille or Drew, as attorneys advising clients on these disclosures, do you have anything else you'd like to add about the value of voluntary disclosure?
A couple observations that I think are consistent with what Ahmed and Ann have been offering as a preview on this topic. Two reasons I see for an increase in voluntary disclosure. The first sounds overly simplistic, but more issuers want to do voluntary disclosure. We're finding this in our practice every day, that good issuers, issuers of all sizes, are wanting to engage in voluntary disclosure. Why is that? I think there are two reasons. I think issuers are becoming more comfortable with the EMA infrastructure, if you will, with electronic submissions. I think issuers are becoming more comfortable with the concept of the special lawyering relationship they have with a disclosure counsel, a counsel that is focused on their special disclosure issues, particularly those disclosures that fall in between primary offerings. Third, I think that there is just an awareness that in the wake of the loss of advance refundings, issuers are looking at the ability to restructure outstanding debt, to obtain lower interest rates, to optimize their cash balance situation. And they're realizing that if we have to go out to existing bondholders and get consents or waivers because we can't advance refund, better to have good current disclosure in the total mix of information. If we have to go out on a cash optimization program and make tenders for outstanding bonds, easier to do, better to do if you're in continual communication with your investors, your bondholders. So I think those are two motivating factors. I think the flip side to all of this, which Adam mentioned in his question, was what about the concern about pricing or liability impact? And we'll touch on that throughout the panel. But as a general overview from the legal perspective, when we're talking about voluntary disclosure, I think it is safe to say that the chances of insider trading liability are unlikely, that selective disclosure to certain investors or analysts is not necessarily going to be actionable under the securities laws so long as you're not being misleading or false in your statements. And finally, the chances that a good disclosure program or policies and procedures can enhance the voluntary process adds an extra layer of protection for the issuer.
I think the topic's been covered fairly well already, but I think that one of the things I've seen a lot of issuers draw a lot of confidence in is the fact that voluntary disclosure gives them the opportunity to communicate good news to the marketplace in the interim. And I think with you have your initial offering document and your standard 16 notice events in 15C212, there's not always an opportunity to share with the marketplace the successes that you've had, or also the challenges you've had, but do so in a meaningful way for all investors to have that information. And so I think, as Ahmed mentioned earlier, you're already providing that information elsewhere within your information infrastructure. So being intentional about making voluntary disclosure of the additional information, for example, changes or increases to capital improvement programs, that sort of information, providing it on a voluntary basis, really creates enhanced visibility and awareness in the marketplace of what an issuer has going on.
All right, thanks everyone. That good stuff. So now let's get into a little bit more of the nuts and bolts. And this first question, or second question, is really more for our issuer and counsel panelists, which is, what are you putting out there as far as voluntary disclosure right now, or what are you recommending to clients to do? And how do you determine what should be voluntary disclosed and frequency? Is it driven by specific investor and analyst demands, practical factors, or such as, as Ahmed mentioned, information that you have to produce anyway? Or what other factors might determine that? I think we can just go right down the line on this one.
Sure. So, I'd say a couple of things there. There's kind of the true voluntary disclosure that does not have any genesis from the requirements in Rule 15C212, and then there's other voluntary disclosure that maybe initially we're looking at through the lens of Rule 15C212, and maybe for a variety of reasons, maybe we don't think it's material as a technical sense, but we still want to put the information out. So, on the true voluntary side, a lot of it goes to the information that we're already producing, generally for governance purposes with City Council and their oversight of the administration. In addition to that, when we're doing a primary offering, we will also, in addition to having the POS delivered to the MSRB and posted on the EMMA system, we'll also include the rating presentation. Seems like if it's good enough for us to make our case for a rating upgrade, hopefully, why not share it with the total world of potential investors out there? Then flipping gears to the disclosures that might be implicated by Rule 15C212, but it's not clear that the financial obligation is material. We have our capital program every year, say, is $300 to $400 million. We have a water department that serves a 10-county region. If it enters into a $2 million loan with our state revolving fund, is that really material? Probably not. It's a pretty standard loan document. $2 million doesn't really rise. It's probably not even 1/2 of 1% of the total debt outstanding for the water department. Nevertheless, our position in the finance department is that we just put that up on EMMA anyway. I view that as a voluntary disclosure. And so it's a way in which, if we're having a discussion about a potential disclosure topic, looking at the rule, the default is to just put it up. I think it is appropriate to view that as a voluntary disclosure because, we're not certainly taking the position that each item we put on EMMA is material. And we make that clear in our filings that we are explicitly not opining on the materiality of this item, but we still think it's important to put out there.
To take your question in parts, I would say our publishing recommendations for clients are really specific to each issuer and then subset to each credit. I don't think that each issuer who has the same credit program can even produce the same information at the same time. And so with respect to content and timing, I think it has to be done on an issuer by issuer perspective. I think one of the main guiding principles we take with respect to our clients in crafting continuing disclosure policies and procedures and identifying what they are going to include in voluntary disclosure is what information can you produce with confidence on a consistent basis, and on what time frame can you produce that information? It's great if you put out some voluntary disclosure that has updated, finance or interim finance and operating data, but if you can't produce that on a regular basis, I don't know if you're really helping yourself as a municipal market participant. Also, with respect to the different types of information provided, I would say, that is really, as I mentioned, very credit specific. For example, I recently saw a toll issuer who wanted to address revenue leakage, start creating voluntary disclosures about revenue assurance and different ways they were handling bad debt collections. Another example is utilities addressing rate changes, interim rate changes that were in response to changes in the market prices for access to fuel. So I think that there are a number of different instances that will impact each credit. And it is very critical for us to have those and I love that you mentioned, a candid and comfortable conversation with your disclosure counsel about what you and your team can actually produce timely and with confidence. Because I think it's very important to make sure that while we want to be as aspirational in our voluntary disclosure, we don't want to overshoot what we can actually do consistently.
Yeah, to follow up on that, and I think that's a very important point about approaching voluntary disclosure from the vantage point of designing disclosure policies and procedures that are actually manageable for that particular issuer. So it's not walking itself into a late filing situation just from the get-go. When I think of voluntary disclosure in terms of content and timing, I think of voluntary disclosure in a legal sense is, one, that kind of voluntary disclosure that is annual periodic information that may be beyond what is required in an undertaking or by the rule. Secondly, I always think of ad hoc investor inquiries and how the issuer will process those ad hoc inquiries from analysts or bondholders. And third, providing information, that is viewed by the issuer as perhaps a material item, perhaps a material event, but doesn't fit neatly into the 16 events under the rule. And so you want to design a set of policies and procedures, or you want to advise your issuer client that however they approach those three, that they're doing it in a way that's going to be manageable, and both as to timing and content. And most issuers, I'm finding most of the activity, most of the calls that come from issuer clients are not about the continuing disclosure that was agreed to in the continuing disclosure undertaking that may be more frequent than annual, or may be more detailed than audited, may be more expansive than audited, but rather how to handle the calls that come from analysts or investors, and secondly, how to deal with those events that an issuer is saying, is this material? Should we consider this as an event notice? Where does it fit? It's not really one of the 16. It's sort of an other. How do we approach that? And so when you're designing policies and procedures for an issuer, you're trying to say, okay, what is reasonable for you in the way of a disclosure committee, in the way of a process, in the way of a person, a contact in your shop that really can monitor this on an ongoing basis? Or what do you need to do in the way of looking to outside consultants like a dissemination agent or a disclosure counsel to assist you with that?
Yeah, and I would just maybe pick up a little bit on the policies and procedures, which I neglected to cover in my initial response. I came into a city that did not have disclosure policies and procedures. We are putting those in place right now. And I think to the other credit topic, one of the things that we are doing is, so in the city we have an airport, we have a water utility, a sewer utility, and a power utility, all under the city of Cleveland. And those other enterprise funds are non-recourse to the general fund. However, I think in conversations with some of the rating agency community, especially at, I believe, Moody's, they take a pretty wide view of what obligations they're looking at when providing a rating for an organization like ours. And so one of the things that we're spending some time really giving some thought to in our procedures is when does it make sense to disclose an obligation of one of these other enterprise organizations under our general fund, under our general obligation debt disclosures on EMA. And I think that threshold is a little different than when we're thinking about what to disclose voluntarily with respect to the airport for airport obligations. We're really thinking about bigger picture potential obligations of the airport that, even though they're not the legal obligation of the city, if the airport failed, I have a hard time believing that investors wouldn't come looking for the city to make good on those obligations. And if we didn't, I also have a hard time believing that our access to the markets would remain as open as it is right now.
I just want to bring one other thing about content and timing on voluntary disclosure. I think that one place that we see less enthusiastic voluntary disclosure is in the realm of, credits that are approaching distress. I think that is a place where there is a great need, and I'm sure Ann would agree. But I think that what I see from a practitioner standpoint is that it's commonly in the face of we are addressing facts and circumstances that are alerting us to the possibility that there may be some distress or some kind of default coming in the future. And I think in those instances, there's usually an analyst who's already reading the tea leaves in advance and may reach out to the issuer or to the trustee with additional questions. And I think in those instances, it does actually serve the issuer to provide that information to, I prefer personally, Emma, as well. I'm not opposed to speaking, with the analyst, but I think that making sure that there is a voluntary provision of information that is, you can rely on if there's any instances of potential, default or distress in the horizon that you're aware of. I think sharing that earlier is helpful, although some won't want to ring the bell early. I think it's valuable. And since I have the mic, I just want to acknowledge that I'm sure there are plenty of practitioners in the marketplace who represent some of these 50,000 municipal issuers who are not of the opinion that you should be jumping into voluntary disclosure. I don't want to, rain on the parade here, but I think that there is a significant portion of the marketplace that still readily acknowledges that risk and accepts that the rules as they are currently established are the rules that everybody should be held to, and are comfortable with remaining within those four corners of that, the notice events under 15 C212 and the contents of your official statement. So while I don't necessarily take that approach that no voluntary disclosure should ever be provided, I do want to say that there are practitioners who prefer to make the decision in that area.
All right, and we will come back to that in a little bit. But before we do that, we talked about content and timing. Let's talk a little bit about venue of voluntary disclosure. So again, let's start with our issuer and counsel folks, and then we'll get Ann to weigh in on this one. But where do you publish or recommend that people publish your voluntary disclosures to ensure they reach investors and market participants?
So I won't make any recommendations, but I'll tell you what we do, and it's very simple. We put information on Emma, of course, and then on our city website, which, if anyone has visited our city website, I'm sorry. It is the same. It is the same website that was built in the year 2001, so it's Y2K compliant, and that's about it. It is not great, and if you can find information, come talk to me. We are in the process of building a new website, which will have a dedicated investor relations page, where we'll kind of collect all the relevant information that we make available. But right now, it's all there, but it's discombobulated.
Yeah, so I confessed to the panel in our preparation calls it. I'm very Emma-centric. I like working with Emma. I don't think Ernie gets enough love for inventing Emma. But seriously, you look at the February 2020 statement, the staff legal bulletin rather, from commission staff about the applicability of anti-fraud provisions to statements made to the secondary market. And one of the key themes in that bulletin is the total mix of information, that information is material if a reasonable investor would consider that factual information as triggering or altering the total mix of information in the market. So I'm always thinking in legal terms, okay, where's the best total mix of information? Where's the best place to have it? And I also think of the Harrisburg enforcement action where they were deficient in their filings on Emma, and they had statements on their city webpage or in their mayor's speeches. Otherwise, there was inconsistency, there was unevenness. So when it comes to venue, I always say the more information you can have in a central, one location, one-stop place, the more chance you're going to have one set of total mix of information that is evenly disseminated. And that means, per the staff legal bulletin from 2020, that the more evenness and more accessibility you have to the total mix, the less chance that an errant fact or an inadvertent piece of factual information is going to trigger the total mix and is going to be viewed as material. So that's a long way of saying, I know that there are, and I work with client issuers that have very sophisticated, very well-designed investor relations web pages, or on their city or issuer web page, a special investor relations tab, and they have someone monitoring that. But at the same time, I like the idea of that one Emma-centric location to look to for the total mix of information.
I concur. I think that if we have Emma as our central repository, we need to use Emma. I'm very comfortable with issuers having investor relations websites and being able to prepare, maintain them and provide information there. But I think that we have to honor the fact that Emma is the place where we are telling investors that they can go find information on any available, any municipal securities that's got disclosure there. And I think that I counsel our clients to make sure that while you may provide additional information, make sure that what's required is on Emma, and if you're providing additional information, it is my preference for it to also be on Emma.
All right, great, thank you. And now I'll ask Anne, and then everyone else can weigh in as well. But as a consumer, what are the pros and cons of Emma versus an issuer website or a standalone investor relations website or some of the third-party platforms or maybe even any other venues as far as finding or, and then for everyone else as far as, producing and publishing the voluntary disclosures?
Yes, thank you. I too want to say that the ideal posting of this information would be on Emma. Where you have a consolidation of a wide variety of information, obviously with perhaps rating agency reports and trades that can help you make a decision about credit and risk in a holistic fashion. That being said, and so hence it's the one-stop shopping approach to where you can find your information. Of course, there are some excellent investor relations web pages out there. And sometimes, obviously, there is a different information set you might find there that hasn't been posted to Emma. For either situation, we look for accessibility, the ease of access, the ability to find what you're looking for. Sometimes it's an arduous task, whether you're using Emma or you're using an investor website page, to find the information that you're looking for. And of course, either way, we expect robust, timely disclosures, or put another way, we're looking for more usable information We're not looking simply for more information, we're looking for better information. I will say that there are private platforms. Much of that data does mirror what one might find on Emma. I will say, quite frankly, that one benefit there is what I would say as organization, the aggregation of a wide set of data that is appropriately labeled. And because that's not always the case when you're looking at items on Emma, and you get that benefit certainly from these alternative platforms. But also, interestingly enough, I'd like to share a comment that the multiplicity of informational platforms sometimes certainly can be confusing and less valuable to the analyst and the investor. And there is a concern about bifurcation of the market, where certainly the quote-unquote sophisticated buyer, the investor, large platforms, mutual funds, ETFs and the like, and the analytical community know honestly where to find this, regardless of where this information is posted. But there still remains a component of the market, which is retail, where QE Public does buy individual bonds, and it's a difficult road for them to hoe to even be aware that this information exists, let alone how to dig in and find it. Because as I said, some platforms are easier to use than others. So I think it's a good lesson that this information be posted to Emma, be clearly labeled, and be robust, and encouraging the issuer community to fill in those gaps between their annual CDA filings, many of which, quite frankly, have been late, to fill in the gaps with this, what I call interim voluntary disclosures.
I think, I want to say with respect to venue, I think best practice, again, is Emma, but I find that one of the problems you have with Emma, particularly in the realm of voluntary disclosure, is we look back at the 2022 MSRB fact book, and I think that it listed approximately 4,400 of the filings were listed as other event-based disclosures from a categories perspective. That's difficult to go in and figure out what they are, and so I think that there's need for additional categories in the other realm on Emma that would be helpful to help categorize information and make it more readily available to issuers. I will say I've seen a variety of approaches. I think, again, continuing disclosure, the provision of it has everything to do with, what you can maintain. And so some issuers, they are, from an infrastructure perspective, only really prepared to handle what's on Emma or adding a few other documents on their issuer website. Some have a standalone third-party website third-party hosted, website that I find for those who do it well is very impactful. It can be cost sensitive for certain issuers who are trying to figure out the best size, the best strategy for managing their debt profile, but also I think Ann's point regarding it actually being aggregated and appropriately labeled is very significant, because I think what we find on Emma, unfortunately, too often is that the labels that are assigned to different documents or even to certain credits are not consistent, and so sometimes it doesn't aggregate as well as you would like for it to be. I will say for the more sophisticated issuers who are using, a standalone investor relations website, the ease of access of information is very, very strong. I think one of the challenges for those who are aspiring to that place as a municipal issuer is having the capacity in-house to manage making sure that information is being uploaded to that website, in a manner consistent with what's going on Emma. And again, that all goes back to what works for each issuer's internal infrastructure.
Yeah, there are a lot of technical questions that come up on voluntary disclosure from the issuer point of view, depending on the size, sophistication amount of debt issuances an issuer has out. If they have other information that they want to post on a voluntary basis, where does it go? Where's the right place for that to go? To a certain extent, that gets answered by ensuring that wherever you put it in the list of material events or other on the portal, that you're pumping it out to all the relevant QSIP numbers. So at least the information is getting out there. But, yes, Emma has some accessibility challenges. The issuer homepage idea is not as flexible as investor relations pages on issuer sites may be. So there are pros and cons to it, but probably the most prolific question in representing issuer clients on voluntary disclosure is, okay, we've decided to do this and we've written it up, now where do we put it? How do we know where to put it in the Emma system? And again, QSIPs help to a certain extent, but more clarity, more refinement, as Camille mentions, of expanding that other category so it's more easily findable would be a helpful improvement.
Yeah, and that's one of the things we're hoping to solve with our investor relations page that will be on the new website. And this is selfishly, if I type in the city of Cleveland in the Emma search box, I believe there are 10 city of Cleveland, Ohio options that arise. I have no clue, looking at that list, where if I click on it, where it's going to take me. Is it going to take me to our water debt, our sewer debt? And it can, it doesn't take a ton of time, but when you're looking for something quickly, it can be a real challenge given just the way information is put in by the underwriters at the initial offering stage, and we can kind of control for that on a website that we are curating, and we can organize information in a way that's more easily accessible by anyone who's looking for it.
Great, thanks. So this next question is primarily for Anne, although anyone else that would like to can weigh in. As an analyst, what would you like to see issuers producing to help you make better and more efficient investment decisions or recommendations in terms of the content of voluntary disclosures?
And go easy on us here.
And it's not an inquiry, that this is meant to be a bottomless pit of information that the investment community wants. As I said, it needs to be, decision useful. As I said, I think one of the biggest concerns is that there's an abundance of historical information that is posted on these various websites, whether it's Emma or elsewhere. But we need to see what's the most relevant and current information, which again, if you're a frequent issuer in the bond market, the currency of your information is probably undoubted. It's there, right? So what we would like to see, again, are these interim filings, and by the way, we do appreciate it is case by case, right? And there will be some items of interim voluntary disclosures that candidly, the analytical community investors would like to see in perpetuity, as long as it's relevant. Now, that said, we also recognize that there's some information, if it's posted voluntarily, once we've gotten through the challenge, the event, the success story, that wouldn't drop off. And that would make sense. So we do appreciate it's a case-by-case scenario. It's got to be relevant to the credit. It's got to be relevant to the individual, assigning a risk quotient to all these issuers, and can come up with a peer-to-peer comparison. I think that, again, as I said, we'd like to see this information posted to Emma, and we would also like to see more current information in the context of a real candid discussion of, we're going to own our own story, right? I mean, so many times I fill in the blanks by, we're looking at media reports, right? And that raises questions for the issuers, and why isn't that perhaps not disclosed in the OS if one thinks it's relevant and we know material. So we would like to see a candid discussion of, in the current moment, these are the challenges. We understand what they are. They are in our control or they are out of our control. And here's what we're doing about it. Obviously, we're having a success here, but maybe it's due to a one-off. Maybe it's a source of funding that will expire and it won't be available in future, so how would the issuer continue that positive forward momentum? We get the budget to actuals, which we appreciate, but we would also appreciate the projections, the forecasts, where you're going, right? As of today, what you know, known facts. So what is this going to take you out looking, 1, 3, 5 years? And we understand that will be hopefully annually reviewed, and that story might need to be changed or tweaked. But the analytical community is very forgiving if projections are not met, because what we would then want to know is why. And what can you do about it? And that's a candid conversation, and I think that's a good information set that we would hope the issuer community is comfortable with, if not becoming comfortable with doing that. Because, finance and operating statistics that are 6 to 12 months stale, not terribly helpful. And again, as I said, the historical data provides a basis for making some assumptions about where the momentum might be moving forward with the issuer. But we clearly need a candid current discussion. And we think some of that will be enhanced by what's already been mentioned, is perhaps taking a different look at the input dashboard for Emma, and coming up with an additional, if not different, set of labeling. Because some of it does get lost in the sauce. Just the other day, I looked at an issuer who made 6 filings, 5 of which were mislabeled. Now, and again, we might back up. Well, who input that, and why did they say that an audit was an issuer's certification, that they're in compliance with their CDA commitment, right? I think that's also a fair question. But, everything winds up in other, because in that laundry list of the potential labels, they're not yet available, and we are looking forward to the evolution of that, which we would expect is certainly ongoing at this point. So I think, the voluntary interim disclosures will go a long way in getting past any stale CDA filings. Will provide current information and hopefully a near-term projection on what is facing the issuer by way of challenge, what their success stories are, and put that out there rather than perhaps rereading it, in the local or national news. A lot of the risk assessments, quite frankly, in the offering statements, sometimes are lacking. And I know a hot button certainly is, weather events, certainly, right? But we need to know what the plans are, what the mitigants are, to the best of one's ability. And certainly, that can be handled in a variety of ways. Obviously, it should be in the offering statement. And again, any of the ESG-related risks that have impact on credit, to see some of that, be highlighted within the disclosures.
And just to dovetail with Ann's assessment of, she mentioned that sometimes that time period between annual periodic filings is just not enough to show current known knowns or known unknowns, right? And staff the commission was very helpful, during the COVID period with that May 2020 statement that, look, we're in a situation where there may be material events occurring in between annual filings that just looking to the last annual filing is too stale to begin with. So I think there was a lot of common ground between issuers and analysts, investors on trying to attain some balance of currency on that information flow.
And I would also, note, really this is about, in my mind, curating the story for the issuer. The event notices are, of course, important and really helpful. but they really set the floor. That's kind of the minimum accepted disclosure that the market will tolerate to allow an issuer to continue to participate. And I think most folks want to be better than just the minimally competent. And I think voluntary disclosure and having good policies and procedures and really giving thought to how that story is curated, both good and bad, right? It's not just good news that we have to put out there, is really important to ensure that everything works well vis-a-vis issuer, investor, underwriter, issuer, and the lawyers that are involved that have to sign their various opinions to get a deal done. These kinds of discussions, both in a forum like this, but also back at each issuer's organization, are really important to help make sure that we're all telling the story that we want. I mean, a recent example, not for securities disclosure, but I live in a state where the auditor of state is the auditor of record for municipal entities. We had an issue where an employee was overpaid because of a keying error in the payroll system. We had shared that information with the auditors, but it hadn't made its way to the right people. And they heard about it on a TV report, which, it might shock some of you that the TV report was inaccurate. And so the next day, the auditor came in and was ready to go to blows with us about, how could this happen? What was going on? How did you guys not find this? And it turned out that once we pointed him to the information that we had already shared, everything was fine. And it was because we took the initiative to tell our story that we actually caught the issue. It wasn't Channel 19 in their crackpot investigative reporter that caught it. And it really just allowed the issue that appeared to be a mountain to just melt down into something much less than that. So it's an example of how we, as at least issuers, can help our own cause by being out there with information, both positive and negative, to an ultimately good effect.
If I may also add to the statements that I made earlier, we would also encourage information that's been disclosed to rating agencies and financial guarantors be provided on Emma. Consistently so. They can be in receipt of information that is not generally known to the investment community. And we would appreciate that information be filed. We understand there's asymmetry in the disclosure and in the markets, and that's not going away. But this just makes it worse when that type of information is shared with certain parties and not with others. And even the information that's provided to letter of credit providing banks. I mean, we do see postings. Obviously, we've taken out this, potential liability. Sometimes those arrangements and agreements are highly redacted. But those letter of credit issuing banks might actually have covenants that are different from the bond covenants, particularly if they're more stringent and the issuer gets into stress. That could cause a set of events that wouldn't necessarily have taken place because the covenants are different with the bondholders, and it could create competition for how the situation might be resolved. So that would be appreciated. And also, we do like the rating agency reports being made available, and I understand there are issues around that. But they are good to have, but I would also say it's not disclosure. I mean, it's not a substitute for disclosure, but it is clearly viewed as an enhancement.
All right, thank you, everyone. So we've heard a lot of, I would say, speaking to the municipal securities community. Now we get to the part where I'm going to ask our panelists to talk to me and to us as regulators. Camille, you mentioned that there are some practitioners out there who recommend no voluntary disclosure, who are very, let's say, small c conservative on voluntary disclosure. So, what could make the voluntary disclosure universe bigger? I know, Drew and I think Ahmed mentioned the 2020 staff legal bulletin and then the May 2020 COVID statement. Is there anything that the SEC or regulators generally could do that would help you produce or recommend or receive more voluntary disclosure in terms of, liability concerns specifically that could be addressed by regulators. And I'll open this one up to whoever wants to go first.
I just want to go out there and say I think we'd all love it if you would define materiality. That would really just solve a lot for us. So put that at the top of the list.
Don't hold your breath.
I mean, he asked, so I had to answer. No, seriously, I think the reality is that the voluntary disclosure universe is already big. And it's just the reality that we as a municipal marketplace have to accept the fact that there is a transfer of information occurring in various different places. And I think that, the reality is that, as Drew mentioned earlier, we are dealing with a total mix of information standard that I think the best guidance you could provide is giving issuers more comfort that if something is in fact publicly available, as in reasonably expected to reach the investors, what is that? Is it only on the investor relations website? Is it only in, on MI? I know that there was a 2020 guidance that provided some examples, but I think more clarity on that as to where we can draw a bright line test of, yes, this information is being readily available to all investors, because I think there's a real issue with the flow of information to all investors, and with us having such a retail-centered investing base, it's important for all of that information to be available, readily obvious and available to all investors. So I would say, just continue to provide additional guidance on what in fact is reasonably expected to reach an investor and what is not.
Yeah, I would, I think, offer this, that in terms of what additional clarity or improvements could be made. I know that our legal practice community and other market participants keep nudging OMS, when are you going to give us a new interpretive release that replaces the 94 release? And when are you going to give us more particularity on materiality? And I have to say that read together, the February 2020 staff legal bulletin, along with the May 2020 statement from the Commission, is almost, in my mind, tantamount to as good a replacement to the 94 interpretive release as staff could give us. I mean, I think you read the two together and you see agree or not agree, a clear delineation of how the anti-fraud provisions apply to disclosures to the secondary market, regardless of the intended audience. I mean, again, agree or disagree, but that's the standard. That whether it's media reports or statements by elected officials or staff comments, whether or not that was intended for the investing market, if it's reasonably expected to reach it, it gets there. And in turn, in the May statement, I mean, staff could not have been more upfront. We realized that when we propose expanding the universe of required disclosures like events 15, 16, and when we encourage voluntary disclosure, that there are liability concerns. I mean, they're not unaware that there are liability concerns. I almost hate to wade into it because it becomes a seminar unto itself, but to answer both the question of what additional help might we get from staff and also address Ann's concern about we'd like to see rating agency reports. We'd like to see disclosures to letter of credit banks. That always wades us into, and I know Ann has heard this from councils, well, we can't give you that information Reg FD, or we can't give you that information insider trading. And I think it just for a moment, on the legal side, it's helpful to focus that the likelihood of insider trading in selectively or voluntarily providing information to Ann or to investors is remote. Just the way the case law has developed, I went back to 1992, the Dick Breeden days, right? And he announced with great fanfare, we've brought our first insider trading case in municipal bonds. It was the Kentucky Authority. where they established that an official of the issuer had a duty to that issuer, that had a motive to personally profit in a bond tender situation and made money through his dad's bank account. I mean, it was this, set of facts that can hardly be replicated, but that's unusual. I think, Bob Fippinger's treatise is about as good as it gets on insider trading, that if you are an official of an issuer and you're providing information to Ann for a legitimate issuer purpose, and there's no personal motive for personal gain or profit, that's very unlikely under court standards that you're going to have an insider trading situation. On the Reg FD concern, some additional clarity from staff may be helpful on the inapplicability of Reg D to municipal securities, only because the anti-fraud provisions, which apply to issuers, do not tell issuers that it's actionable for them to selectively provide information to Ann. It's okay to do. It's not a violation of the anti-fraud provisions to do that. It would be perhaps of concern under Reg D if Reg FD, if that were applicable to municipal securities. It's not applicable. But yet practitioners look to Reg FD and the corporate side and they say, okay, there's safe harbors in that rule for reporting companies. They can have conversations with rating agencies. They can have conversations with others than market securities professionals that may have an incentive to trade on that information. The long and short of that is that when we're looking at voluntary disclosure, would it help to have some additional clarity for the practice community on not so much insider trading, but selective disclosure? That may be a topic to look at, may be a difficult topic. One approach I know that the lawyers suggested a few years ago was on selective disclosure, give us reduced standards of liability for the type of information it is. If it's fully vetted information provided under the rule, it's a high liability standard. If it is information coming from Ahmed's staff, that might be a lesser liability standard. If it's media reports, the liability standard to the issuer is even lesser, with the bottom line being it can never be false or misleading. I'm not sure how staff could ever try to gradate those tiers or levels. It would be impossible. Leanne we'd have to give her smelling salts over at enforcement to figure out how to assign those levels of liability. But I do think for a number of practitioners, a selective disclosure issue remains of concern, and more clarity on that may be helpful.
So I can hit on a few of those points, maybe say a couple things Adam might not be in a position to say, given that I'm not carrying the SEC flag any longer. I would say with respect to the 94 release, speaking for myself, when I was in OMS, we received a lot of requests to update the 94 guidance. And I would just, at least from my interpretation of the events that were transpiring when I was in the office, you're correct in that reading the February 2020 statement and the May 2020 statement really addressed the landscape, in my view. And I honestly don't know what else there is to say to the market when we're talking about broad principles of how issuers and other market participants should think about secondary market disclosure. I think it's all addressed kind of between the bulletin and the COVID statement. And with respect to forward-looking statements, which I know are the things that give people maybe the most heartburn. We couldn't. The May 2020 statement could not have been more explicit that good faith attempts to convey forward-looking information will not be second-guessed, and that's there on purpose, and is my read of that is if someone in my shoes or someone in my staff is putting together some information about maybe what we think income tax revenue is going to look like over the next year, if that is based on real information that we have in our accounting system, maybe the last 12 months, some historical trends, and we're projecting out, and it turns out those numbers are incorrect, say because a pandemic hits and our income tax collections go down 25% in a year, so what? From a legal liability perspective, the projections were made in good faith at the time that they were provided. We can't control the intervening events that come into the future. And so I think, I generally, when I speak with colleagues, around in the state and around the country, I'm absolutely one who's encouraging folks to provide that kind of information for a lot of the reasons that Ann and others have laid out, that it can be really important. And then on the Reg FD point, that was something that we heard a lot. I hear it a lot now from unnamed lawyers that I interact with on bond deals. And I mean, if you read Reg FD, it's crystal clear on its face it doesn't apply to our world. It applies to registered securities. Ours are not. Now, I think as a matter of policy, selective disclosure is problematic. It impedes an efficient and wide-ranging flow of information, can make, put some investors in a better position with respect to information than others. But because of the legal structure of our market, that has no legal consequence. And so I think this is an issue that is one where the law and policy kind of get tangled up, and sometimes policy is getting confused for law. And I think that's an area where the bond lawyers and security lawyers in the market can help give better advice to their clients, better education to their clients, and perhaps something the SEC the staff could be a little more explicit about in public. But I felt it was a distraction when I was at the commission. I feel it's a bit of a distraction now when I get legal advice that is really policy advice from my attorneys.
Yeah, no, understood. And the legal and the policy, I mean, clearly staff has, going back to comments from the Office of Municipal Securities as it was at the time Reg FD was finalized, was that, with respect to the municipal securities market, there's a strong policy against selective disclosure. And the point from the legal side is that Reg FD and selective disclosure law, as it has evolved for corporations, should not serve as a shield for voluntary disclosure in the municipal market. Rather, it provides analogous guidance to manage how one goes about that selective disclosure. This goes back to disclosure roles of counsel in 2009, 2010, where we said, look, on selective disclosure, there are going to be situations that are going to necessitate special handling, okay? And there's going to be, if the tax-exempt status of your securities is threatened, if you're falling off the cliff on revenues, if you're a College of New Rochelle and your tuition revenues are going right down the pipe, this is not just a matter of sitting on the information and not disclosing it. It's rather considering, okay, what is the best voluntary means to get to the ends of the world on an equal dissemination, broad dissemination basis, so the total mix of information has that. And so I don't think, the policy and the law can come together on this. That's for sure. One question I credit, John McNally at Hawkins and Paul Mako, who was writing the securities law column for NABL at the time, this statement about, if you take the following steps on forward-looking disclosure, we enforcement or we the commission are not going to second guess. Well, what does that mean? And Paul and John pointed out in their respective writings how, given that for continuing disclosure to the secondary market, you're under 10B and 10B5 and have to prove scienter or recklessness, that's a pretty high standard. It's a rare statement, but maybe it's not so difficult to make. from an enforcement point of view. But having said that, you know, I tell issuers there are outer limits to how far you can take that comfort that voluntary disclosure on forward-looking information or updates of forward-looking information may not be actionable. Municipal issuers always receive well mention of the Cheesecake Factory, and I always bring up the Cheesecake Factory enforcement action, which after staff gave the statement to corporate issuers about the more disclosure the better during COVID, and they gave us the May statement, the more disclosure about COVID, the better. In December, enforcement, you know, sent a message to the market that we're not going to second guess, but we can't stand by if there are false and misleading disclosures made on an 8K or in the municipal market voluntary basis. There are limits to what we'll tolerate. And in sympathy to Cheesecake Factory, you know, it was an awful time in the pandemic, and they were probably all working remotely, and it was a no-admit case, and it was a small fine. They probably made up the fine they paid to enforcement in one night of cheesecake sales. But the facts in that case were they went to the market in a March filing and said, we're a sustainable operation, pandemic notwithstanding, when the facts showed that they were losing $6 million a week, they had only 16 weeks of cash left, and they were telling private equity investors, we need liquidity because we're in trouble. So you can't tell the market one thing and be telling on an uneven basis your liquidity providers something else. And then in a second statement, they said, you know, we're maintaining flexibility to come up with financial answers to all our problems going forward. And at the same time, they were telling landlords, we're unable to pay April rent, okay? And so I always point out to municipal issuers, you know, when you go out with voluntary disclosure, you've got some leeway here under the anti-fraud provisions. If it's current status you're talking about, focus on the known knowns and the known unknowns. If it is future statements, forward-looking statements you're making, bespeaks caution, cautionary statements, risk factors, and yes, the commission may not second guess you, but on the other hand, what you say has to be accurate. It can't be materially misleading, or you end up in a Cheesecake Factory situation. Okay.
Yeah, I think those are.
I do want to leave a little bit of time for questions. But
yeah, just one quick. I think those are terrific points, and you know, my interpretation of that case and kind of the various statements that we're talking about is that the commission isn't going to second guess. However, it will test the accuracy or the reasonableness, and if it's reasonable, then you know, go on your merry way. If in this case you're telling private equity one thing that is 180 degrees from what you're telling the rest of the market, reasonableness is a bit of a stretch there.
Yeah.
Before we jump to questions, I want to mention the value of training for continuing disclosure and how that it needs to be shared broadly within municipal issuers. I think it needs to go beyond your traditional debt management team. It needs to extend to, I mean, each issuer is their own, you know, entity in its right, and you need to craft it appropriately. But I would usually like to see disclosure training, you know, particularly on this topic with respect to voluntary disclosure, be provided to electeds and appointeds. You know, it's a challenging space to be in. I've been in the, you know, seat as the person providing the trainer, and I've watched some of my clients squirm, you know, providing training to some of their bosses. But at the same time, I think that if you help to continue that awareness of these sensitivities that the panels raise, the training will absolutely do its job, because I think it helps people be more mindful of the fact that they are facing real-time risk if their information is not accurate.
Yeah, and just to briefly follow up on that, and you know, one thing I know NABL suggested to the commission at one point that may be worth revisiting is revisiting the standards in the Orange County report given the desire to increase voluntary disclosure?
I know we're running out of time, but just briefly
Go ahead.
about this. As to clarification, I've had conversations with issuers who, despite those two guidance pieces and interpretations thereof, are still asking for more. As I say, I'm not a lawyer, but I read those statements and I thought it was quite clear, quite frankly, and should have given the issuer community the comfort they needed to move forward. Understanding, again, we expect it to be accurate. We expect it to be truthful, and as it pertains to voluntary disclosures and projections, we get it. It's the known facts at the point of the time. You do your best, and then you explain any variances. As to Reg FD, it's interesting. If you go to nfma.org, there's a resources tab. You will find NFMA's statement in regards to Reg FD when it came out. And at that point in time, many doors closed to the analytical community. Issuers said, they're hiding behind the skirts of Reg FD, and we're pounding the table saying it's not relevant to our market. We actually produced a piece that provided the analytical community guidance on what we would say in return to being shut out from those conversations, which we had prior to that. So I think it's important that we continue to educate the market on that, and that it's not helpful to any investor or analyst who's trying to make a decision if they can't get the information. And by the way, I would suggest, if the concern they gave me information that didn't reach the full market at the same time, you've had that conversation, you've taken notes just like I have, post it as a Q&A on Emma.
That's excellent. Thank you. I guess we've got a couple minutes if maybe there's one question. Sure, go ahead. There's a little lever on the mic. Yeah, there you go.
Can you hear me?
Yes.
Can you address the 94 interpretive release was approved by the full commission. Can you address, I guess, the relative authority of the 94 interpretive release versus the authority of the two 2020 statements, and how practitioners and issuers can rely on the two?
So what I can say, I think, is that, if you look particularly at the staff legal bulletin, there is a disclaimer on there that talks about it being the views of staff and not the views of the commission. And obviously, we recognize there are differences there. The COVID statement was a joint statement of then Chair Jay Clayton and Director of the Office of Municipal Securities, Rebecca Olson. So that does have a commissioner speaking on it at the time. But there's not much more that I can tell you other than, yes, we recognize those, and I think the statements themselves communicate the differences, and we are aware of them. And I think, on that note, we are just about out of time, so I am happy to thank our panelists for joining us today. Please take the next 15 minutes to go enjoy the coffee and pastries outside. Thanks.